Welcome to Lessons from the Sell Side Trenches, alignment and understanding different types of buyers. This session is presented by Bodman PLC and PMCF. Let's meet our panelists. Timothy Kraus, Senior Vice President and Treasurer at Dana Incorporated. Robert Metz, CEO at FM Sylvan Incorporated. Jan Ness, Executive Chairman at Verge.io. Joe Wagner, Managing Director and Partner, P&M Corporate Finance, LLC. And your moderator today is Tim Damschroeder, member and co-chair of the Business Practice Group at Bodman PLC. Tim, take it away.
All right. Thank you, Jim, for that introduction. We're happy to be rolling here this morning, even in this environment. Obviously, we would have much preferred to be in person. The panel, we got together a few times before this to talk about how we were going to handle this given COVID-19. And we all decided that it would be best to try to treat this as a good experience for everybody for M&A and transactions that we deal with, and not totally focus on COVID-19. So if it comes up naturally in a conversation, we'll bring it up. But I think everybody has been inundated with COVID-19 webinars and information, and we want all of us desperately to get back to the new normal. And I think part of that is going to be done by us just focusing on what we all do for a living, and getting back at that. So again, Jim, thank you for the introduction, and we'll get things rolling here. We're going to start out by asking a question of a few panelists about what their typical deal is and what their role is in a deal, just so you can get an idea of what kind of panelists we have. So if we can start out, Joe, with you in that one.
Yeah, sure. So as an investment banker, I basically advise my clients on planning for and executing their sale, acquisition, or recapitalization transactions. A typical deal for my firm involves a family-owned or private equity-owned business that's seeking a sale to a third party. We also work with large corporates, advising them on divestitures and acquisitions. The key, obviously, in every one of those situations is to position the business appropriately, find the buyer, find the target company, and obviously secure an outcome that achieves our clients' objectives. We primarily work in the middle market, so we define that as transactions that would be less than $250 million in enterprise value across a number of industries. I lead our industrials practice, but we also cover business services, healthcare, IT, and consumer and retail.
Thank you, Joe. Tim?
Hi, yes. So a little different than Joe. So I work on the corporate side. For us, typical deal size can range anywhere from a couple of million for a tuck-in, all the way up to $500 million in transaction value. So we typically have a overarching industrial strategy for the business, and we're constantly reviewing the portfolio, both on a potential divestiture side, but more recently, mostly on the acquisition side, to fill out the portfolio with either market expansion or usually competencies that we feel are better to acquire versus try to build internally. My typical involvement in a deal is everything from working with bankers to assess targets, to managing the process. Most of my time is spent actually on the negotiation side, on the transaction agreement itself, and then going through closing, regulatory approvals, and then anything that would come up after the deal. So really runs the full spectrum of a deal life cycle.
All right, thank you. And lastly, for this question, Rob.
Thanks, Tim. Yes, different than Tim and Joe. I am an owner-operator of a business that partnered with a private equity firm to grow primarily through acquisition. And we look to grow our business by adding additional services in existing geographies and markets, and looking to grow our business as well through entering new markets through acquisition. So my role in the process is to work with the private equity firm and investment bankers to understand how different targets might be a good cultural fit. Probably the biggest focus I have on every deal is how culturally will the leadership in the target organization fit with our existing team, and result in more growth together than we would have if we did not join. So additionally, I look post-closing. Prior to closing, I'll work with the target company to understand how things will look after the deal is closed, and how we will operate going forward for maximum efficiency and succession planning and success for the future.
Thank you for that. So as you all can see, we have a wide variety of folks' hats on the panel. We did that on purpose so that we can get a lot of different perspectives. As I think all of you have been told when you logged into this, there is a chat box. And if you throw your questions in the chat box, when we're done with this, we'll go through and answer those. So we appreciate all the questions. That would be great. So moving on to the second question, and that is a little more meat on the bone here. When is the right time to start selling, and what steps are important early in the process? And let's start out with Tim Kraus.
Thanks. So I think from a corporate perspective, really the right time to sell is once you've identified that the asset that's inside the portfolio no longer really does meet the strategic objectives of the company. So, if you have a good industrial strategy and you're executing against it, I think it naturally comes up that, hey, these are either the businesses or in-market products that no longer fit, and then to start going through the process of organizing and going out and determining what the best way to divest those businesses are. I think the most important aspect as you sort of work through that process is really getting a commitment from the business that the asset is in. We run a number of different business units. Without that involvement and without the buy-in that, this isn't really needed within the portfolio up front, the sale process tends to lag and sort of languish in sort of nowhere's land, where the business really has to drive the process to get the asset ready to be able to be marketed. I think is really the key aspect. As the bankers would tell you, putting the documents together and really understanding the business, and then really marketing and selling the business to prospective buyers and presenting it in a way that's interesting and cohesive is really the most important part as we start that process.
Have you seen, Tim, a situation where, or maybe you can describe a situation where a company is definitely entered in too early and/or doesn't have the right advisors, and they're behind the eight ball from the beginning?
Yeah, I think we've entered into sort of on the buy side where a teaser comes out, you're ready to engage with the potential target, and the due diligence process is really not well organized or well thought out, and you end up spending an awful lot of time, energy, and in some cases money. That really, makes it a difficult process. So, when you think about it from the buyer side, you really do need a well-organized and thought-out process in order to make sure it moves through. Because at some point, the buyers become, at least we do, if it becomes too arduous and not well, not a good process, we will sort of walk away and generally there isn't a single asset for us that we would be interested in and we'd go elsewhere because it's just not worth the limited amount of time and resources we have to spend on it. So.
Okay. Thank you for that. Jan?
Yeah. So thanks, Tim. I probably see things a little differently. I think the day you begin selling the company is the day you start it. What I find happening a lot is people run a company, start a company, run it for 5, 6, 7 years, and then they say, "Oh, let's go to market. Let's sell this asset." But they don't really fully understand the sandbox they're in. I think the best time to sell the company is when you're the shiniest object in that sandbox. Understanding that sandbox really, really well from day one. Who else is in that sandbox? Knowing your business really, really well, know all your metrics, know your benchmarks, know the investment bankers in the space, know the other strategic acquirers in the space, know the financial acquirers in the space. At Online Tech, I think for 10 years, I would every quarter call the 5 biggest investment bankers and the CEOs of my competitors and just kind of tell them my story and hear their story. And so when we went to market, we were one of the prettier girls at the dance, and that was sort of by design. So I think it's really, really important to know the landscape, not who you're selling to. You got to know that, but know the landscape of assets like you that people would acquire. Otherwise, you miss time. You might build the wrong company. Especially in the tech space, I've seen people start a business and say, "We're in this space, we do this thing." And 6 years later, they're still doing that thing. And guess what? The tech space has moved on. A third of what we sold at Online Tech in any 1 year were products we didn't have 4 years ago. Think cloud, cybersecurity. And so you have to completely and constantly understand the pulse of who's buying what's driving value. And if you wait until you're ready to go to market or until you want to get out, you're kind of behind the 8 ball. So I think you're selling the business from the day you start it. Having said that, I will say that build the business to sell and to keep, because this is really important. Every day you don't sell it, you bought it. And you got to go home that night and be really proud of your asset, just like your house. Think about your house. You don't wait to put a new roof on it until the day you sell it. You don't wait to understand what other homes in your neighborhood are going for until the day you sell it. It's an important asset to you, so you understand what drives the value of that house long before the day you move out.
Yeah, Jan, I think those are excellent points. To me, though, what I think would be very difficult, I don't know if you can give some insight to this, maybe it's too amorphous, but how does an entrepreneur like yourself with Online Tech understand what they need to put their capital into to make you the prettiest girl at the dance? How do you figure that out?
Well, let's use the Wayne Gretzky phrase. You got to go where the puck is going, not where it's been. So my background is the tech space, and the puck moves really, really fast in that space. And because because of that, you have to understand what's going on. Read industry reports, understand what drives value in the other acquisitions, understand what you're already good at, do your SWOT exercise, understand what the opportunities are in your space, and make sure you're investing in the things that you're good at and the things that are going to drive, adoption, revenue growth, which I think is one of the most important drivers of value.
Okay. Joe?
Yeah, so I think Tim and Jan make excellent points. I'd say from my perspective in the advisor chair, the answer to the question is really different for everybody. I think the right time to sell is when the business ultimately is best positioned to achieve that particular owner's or ownership group's transaction objectives. So, there isn't a one-size-fits-all approach. And if you think of what the different objectives are in a transaction, obviously it's a common one is maximize value. That's usually at the top of most sellers' lists, but there's also legacy preservation. There's opportunity for employees and management, whether it be as an owner or investor or just as a continued member of the team. There's the timeline or certainty to close. All of these can be really important. That can drive ultimately, when the right time to sell is. And they all have varying degrees of importance to the seller. I'd say, given that, what's really important, and Jan touched on this a bit, it's the importance of planning early and understanding before you even begin to sell formally what your business is worth, how it's positioned in the market, what are the potential, green flags, yellow flags, red flags, and if there are red flags or even yellow flags, how do you mitigate those risks? So if you think about maximizing value, for example, obviously it helps when the capital markets and the broader economy are solid, which in this market makes this a little bit challenging. But if you think about the company specific attributes, the growth opportunities ahead of the company are really important. And so a common error in sellers' view or kind of mentality when they should go to market is that they should sell when the company has sort of wrung the sponge dry of growth. So they're kind of selling at the peak of the growth curve. And we like to think of it where they should be selling at the early stage of the upslope, because the buyer wants to have visibility into what the trend line looks like. And obviously less risk means you're willing to pay more for those cash flows. So having that planning exercise is really important in terms of what the right time to sell is. And that's obviously as it relates to maximizing the valuation. But obviously there's different components to it, different variables, depending on what the objectives are.
But Joe, when you do that, isn't there some danger of leaving money on the table? Because you're always chasing EBITDA, right? And EBITDA being the primary driver of the value and the purchase price you're ultimately paid. So if you're doing it too low, I hear a lot of my clients say, wow, my EBITDA is, going up every quarter. It's getting stronger and stronger. And, maybe I'm doing this a little early.
I think it's a great point, Tim. But if you think about it, if you wait too long to do that, eventually trend lines do reverse generally. And so what you want to do is balance demonstrating a track record of growth against visibility into the future. And if you do that appropriately, you can maximize value before you, again, I'll use that sponge analogy, kind of wring it dry. You want to leave some moistness in the sponge for the next guy. And so, balancing that is at the right time is critical. Yes, you do risk leaving money on the table if you do it a little early. But on the flip side, you can wait too long and then it's too late. And one common phrase I always tell my clients and folks I just know out in the industry is, you can sell a day early, but you can't sell a day late.
Yes.
And I think that's a really important thing to remember for folks when they're considering a transaction.
Yeah, I think there's one other point, and I work with technology people. A lot of companies are never bought. It's a bit of a binary outcome, to be frank. And so it's not like, oh, if I sell later, I might get more. If you try to sell later, you may get nothing. And again, every day you don't sell it, you bought it and you own it. And just as we were talking about the stock market going through the roof these days, it's, you should sell things when things are going up, not when they're going down. And when things are going down that's your time to fix things. And I would also say, Tim, that one more thing, it depends on why your EBITDA is growing. I mean, if your EBITDA is growing because you're doing a fantastic job of slashing expenses, that may not make a buyer very excited. So I think selling during a growth phase is actually, I think, a better plan than not most cases, because it's a pretty binary outcome, at least in the tech space. And selling when you're not doing well, because it's a binary outcome, you may not sell the business at all. And if you go to market and don't sell a business, you're back in business for a number of years.
Yeah, you are. When clients ask me that question, I typically say the two things that I see kill a deal most often are, number one, a buyer is not able to get their financing. They're either trying to put together equity or debt, and some structure or some other problem kills it. And we do everything we can right all the way up to the end. Everything is absolutely greased and beautiful, but the buyer can't put their financing together. And then the other thing is bad results during the middle of the final diligence phase. That kills a deal faster than anything does, and forces or allows a retrade of pricing more than anything else. So I think that's all an excellent point you guys are making. All right. If there's no more thoughts on that, we can move on. The next one is describe a shock or surprise in a deal and how you got through it. And this time we're starting out with Jan.
Yeah, so I'll say I've been through 7 liquidity events, and I can say every single deal had a shock or surprise. Never seen that much money land on a table and the creeps come out of the woodwork. And for smaller companies, doing everything right is hard. Make sure every employee issue is closed off right. Make sure all your regulatory stuff is right. Make sure all IP assignment is perfect. It's the most thorough review of your business that will almost ever happen. And unfortunately, I think a lot of companies don't run their business in the high quality state you need to be to easily make it through due diligence. So you always uncover something. The 2 things I've seen happen more than any other one thing in my space. Number 1 is distrusting shareholders that were around very early on. And founders may not do a very good job of communicating with them every quarter. And then comes time to do a liquidity event, and all of a sudden everybody's sticking their hand out. I've seen non-shareholders. I've seen parents of a founder. I've seen an in-law of a founder say, I gave you the idea, and sue the poor kids. These were young founders. It was a nice deal to the Carlyle Group. And they basically use cash and you pay the guy off. So I've seen, make sure your shareholders are kept abreast of the business all throughout. Shareholders hate to be communicated only when there's big bad news or big good news. So send a quarterly update to all of them and interact with them, interface with them, know them, build the trust in a relationship with all of them. Second thing is in the tech space, IP assignment. I had a deal, sold a company to Liberty Mutual, and we had a contractor that had built a huge piece of our software that I did not get proper IP assignment in the contract with them because I didn't use a guy like you, Tim. And sure enough, and I thought he was my friend. We'd spent millions of dollars with his little company, and the acquirer was going to spend millions more. None of that was good enough for him. He wanted a nice fat payment at closing, or he wasn't going to sign this one piece of paper, even though that everything was, understood that we owned everything, but we had to write a check to him and sign the piece of paper. So I would say stay close to shareholders, get to know them, build trust with them, and make sure all of your IP is properly assigned. There's a bunch of others, but those are the 2 big ones in my experiences.
All right, thanks for that. Once again, just a reminder to everyone to hit that chat button if you want to ask any questions. Those would be much appreciated, and we can handle them after this. Okay, Tim?
Yeah, I think you should, if you're going through a deal, you should expect that the unexpected is almost certainly to occur. Whether it be, as Jan pointed out, somebody coming out of the woodwork, putting their hand out, or for us, it was something we hadn't really considered. We were working on a transaction a number of years ago, and we went in and made a pitch to the business, and 2 days later there's a hostile takeover launched, and the entire dynamic of the transaction really started to move. And so you have to really be prepared for almost anything as you start working there, especially as the deals, deals that are really small or deals that are really large. It doesn't really matter. The dollar amounts that are moving around might change, but the problems or surprises are the same. So, it was, in this particular instance, it moved far faster than we thought it was going to. And, we started to take on the role, not so much of the white knight, but we sort of, went from, trying to convince them that we would be a great owner of this business to them saying, yeah, I think you would be a great owner because now we can we can work to try to manage this takeover bid. So I think making sure that your own internal processes and the way you're thinking about the business and the process to acquire the business are flexible enough to deal with the issues that are going to come up, throughout the deal. If you have a very regimented and controlled process that doesn't allow for variation or adaptation, maybe is a better word, then you're going to be frustrated through the process, and a lot of deals just aren't going to get done that probably could have gotten done had you had a bit more adaptable process through it. So I think that's what I've seen through the last 3, 4, 5 years of trying to get some transactions through.
Okay, Rob.
Yes, I've been a part of over 50 deals over the last 20 years in the transaction process, and with Yen, numbers of issues that come up throughout the process, but and really right to the last minute. First deal 2 years ago was a liquidity event for me and as an owner, and so I intuitively knew that there could be issues, but more stressful to deal with them when you own the business. So in our transaction recently, we had 2 issues. One, in our last month to calculate the trailing 12 months earnings, we had a significant issue with a client that certainly seemed significant at the time, and would have impacted earnings and our LTM. And we weren't really sure how it was going to turn out. And I made the decision to be very transparent, explain the issues to the buyer at the time, really at the 11th hour of the process, and said, here is what is going on. Here's what I think is going to happen. But there are negotiations to be had, and I can't guarantee an outcome. And so we worked through that process. We moved the timeline out a little bit, and that was uncomfortable, but I think it was the right thing to do, to be transparent and to explain every issue that was going on. And ultimately, we worked through the issue with the client, and we closed the deal, and it was a positive outcome. Additionally, I have a minority partner who had a real issue with some of the non-compete language. And he would have signed the agreement, and he's been a great partner to me for 10 years. And he was very much on board going forward, but he had a major issue with the non-compete. And he said, look, I'll sign it if you want me to, but I really am uncomfortable with this language. And I made the decision at the 11th hour, with some risk, to spring that upon the buyer. And I'm happy I did, because that person is a great partner today and will be in the future. And I think it was the right thing to support him in where he was concerned in the deal, so he felt good about it going forward. Difficult discussion with the buyer, and they didn't really have a huge issue with the language change, but they did have an issue with the timing and springing on them last minute. And I took some grief for that, but felt good about how the decisions I made in both scenarios.
All right, good. So let's move on to another question. What are the biggest drivers and impediments of value for a deal? Let's start out with Joe on this one.
Yeah, we've talked a little bit about this already, so I'll keep this kind of short, but I do think Rob made a great point there about generally alignment with the team. I think, a lot of deals ultimately fail after the deal closes, and one of the biggest reasons for that is misalignment. So I think going into it, the opposite is true. If you're fully aligned with the buyer and the management team and the partners, really helps improve the odds. So that's just a general comment in response to Rob's point there. I talked a lot about growth. You hear a lot about industry multiples and, oh, I do 10 million of EBITDA in my industry and typically trades at an 8 multiple, so my business is worth 80 million. Well, that may not be true. The question should be asked, how do we get a premium multiple for this business? And it gets back to de-risking it for the buyer, which I talked about previously, and really demonstrating support for the growth of the business, which really drives a premium multiple. So I think growth is probably the most important thing to prove out when you're selling your business. In terms of impediments, so there's a lot of things that can happen. Tim, you mentioned sort of a fledgling financial performance during the deal earlier. I think one of the biggest things I've seen, and we actually work very hard to mitigate this in a process, and that is an unprepared management team. I think there's 4 or 5 things a management team should really focus on heading into a process, and they may or may not be owners. So it's sort of on the ownership group to make sure that they're prepared, as well as the advisory team. They should know the numbers. They should know the differentiators of the business and be able to sell that to the market. They should demonstrate expertise in their functional area and then have a strategy. And I think if a management team can do that effectively, that is, again, a nice driver of value. But if they don't do it, it's a huge impediment to the process. So those are just a couple of things I thought were worth noting as it relates to both value drivers and, I guess, eroders.
Yes.
All right. Well, thank you all very much for taking the time out. I'm glad we were able to do this. And now we can move on to the question and answer part of the process.
Thanks, everybody.
Thank you.
Thanks, guys.
All right. I think we're on to the question and answer session now. Thanks, everybody, for the great discussion so far. First question was for Joe. Do family-owned businesses tend to roll over equity when selling? And how important is it to families to maintain some form of equity ownership?
Yeah, so good question. You know, it really depends on what the family or shareholder group wants. We really see it both ways. And frankly, you can go into a transaction designing a process to, accomplish whatever you're looking for. So if you do want to roll over equity, sometimes that's a situation where, there's a desire to take chips off the table, but you still want to participate in the growth of the business, still want to participate in the value accretion, and still want to be involved in the company. That's more typical with an equity fund buyer. Sometimes the sellers want to walk away, and a rollover isn't necessarily in the cards, and that's more typical with a strategic buyer, although that's not binary. It can go either way. So it's hard to say what mix you see, but it really depends on what the sellers want. But, I'd say it's, you definitely see it on both sides of the equation. It's very much driven by objective for the seller and then what type of buyer you ultimately go for.
All right. We wanted to move on to maybe a couple of other points and see if a few more questions roll in. But Jan, you had a thought that you wanted to talk about a little bit.
Yeah, I think this is important whether you're on the buy side or the sell side. This has happened to me on both sides. Is keep running the business as you're going to own it for a long time, even while you're in process, because not every deal closes. And it's a little awkward, and you put yourself in a strange position if you start making a bunch of decisions about the business for the buyer that you wouldn't normally make in the normal course of running the business. In fact, a lot of deals are structured such that they require that you run it in the normal course of business, and it might not close, and then you still have it. So don't spend the money before you have the liquidity event. Don't even calculate it. Don't spend a lot of time on what you're going to do when this thing closes. Having said that, there is some integration planning you need to spend time on. And same thing on the buy side. We got really far into a transaction, buying a smaller hosting company about 10 years ago or so. And we got all the way through due diligence, and we were 4 or 5 days before close. And we had all kinds of plans. It was going to expand our market here in the US. And we'd already launched some marketing initiatives that we're going to pull the trigger on, and did a bunch of work. And then we got a call from the CEO saying he didn't want to do the deal about 4 days before closing. And so just, be careful, run the business until it closes as if you're still going to own it.
I think that's excellent advice. Another topic that we've been talking about as a panel is rep and warranty insurance. We've all had experiences with it, different experiences with it. And let me just ask around the horn here for thoughts about that, starting with Rob.
Yes, I think as you negotiate get the meat of the financial agreement and terms of the deal and moving forward into the management and into the contract piece, it was something that was introduced to me, and having not been familiar with the product for over 10 years and recalled over 10 years ago, the product was not very user friendly. And when you get disclosure statements and baskets and escrow and so forth, it was a great solution for me selling to a financial buyer who brought the product to us and facilitated the contractual process. So it was a good fit in my situation.
Yeah, I think I've spent most of my time on the buy side. I think we would prefer to not use rep and warranty insurance. We would prefer. We think we've had better outcomes dealing with the seller on issues around reps and warranties. I will agree the product has definitely evolved and is much more useful today than say 10 years ago. But I think our preference as a buyer typically would be that we would resist trying to go down the road of procuring reps and warranty insurance and either do a holdback or escrow to secure the reps and warranties under the contractual obligations of the seller. So
No, go ahead, Tim. I'm sorry. We don't.
Please. No, please.
I can say from a deal lawyer perspective, it can be very handy because the reps and warranties themselves in the contract are anywhere from 10 to 20, 30 pages. Not that long, but 10 or 20 pages of reps and warranties. And they can be one of the more difficult parts of a transaction. And most people want a transaction to close, right? The buyer and the seller, they're motivated. They want it to close. It can become quite burdensome and restrictive to the closing process to go through those reps and warranties. But if you have rep and warranty insurance, you can oftentimes put in as a seller maybe more than you might otherwise want to offer, because the insurance company does their underwriting of the transaction and they review the reps and warranties and the scope, and then they underwrite it. And you do have some exposure at the beginning of the claim period as the seller. You always have your minimum basket that you're going to be covering. But sometimes if you weigh getting a deal closed and being able to maybe have a little more expansive reps and feel comfortable about them can be better with insurance than otherwise. So I think that's a helpful thing. Joe, you have a quick point on that? We got another couple minutes, I think.
Yeah, I would agree and understand with both sides depending on what side of the table you're on. When we're working with sellers, though, I think it's a hugely beneficial product, particularly because it puts meaningful more dollars in your pocket that are not at risk and meaningful. The retention on a policy is significantly less than the typical escrow in a transaction. So it just makes all the sense, particularly if there's potential risk of claims. So we do see it on most of our deals.
Yeah, I think it's going to continue to go that way as well. I've also found that strategic, and I'm not surprised that Tim Kraus is saying that as well, because I do find that strategics are a little less likely to do it. And, they oftentimes, I get the same response. Yeah, we've done a few, but we'd rather not when it comes to that. And I think, Tim, you did mention in our offline chatting that
you understand in the PE context that it's much more prevalent, especially in a context where PE is actually selling the company. It's difficult to look back to the limited partners and so forth. So, well, thank you all very much for the being a part of this panel that Joe and I have hosted, and we can move into our post-session discussion room now. Thank you all very much.
Thanks, Tim. Thanks, Joe.